A majority of investors say they want to invest in sustainable companies or funds that achieve market rate financial returns, while also considering positive or social environmental outcomes. And they're confident they can do it without sacrificing profitability. But that could be a tall order in a whipsaw political and economic environment, both at home and abroad. And it's not just a matter of finding green companies that are pursuing ESG or environmental, social, and governance goals. A truly sustainable company, regardless of products or services, has a plan to grow and thrive in a low carbon future. So, how can investors parse the evolving complexity of sustainability assessments, ESG scores, and emissions reporting? On this Industry Insights, we discuss IBD's 2025 Most Sustainable Companies list and how they're well positioned for investors concerned about the climate transition. IBD's 2025 list of the most sustainable companies reveals which companies are leading the way to a lower carbon future and are ready for the challenges of the energy transition in the coming decades. The top ranks are filled with financial services, utility, and consumer companies. The 50 stocks on this list combine strong climate management scores from Morningstar Sustainalytics with superior IBD technical and fundamental stock ratings. To build IBD's 2025 list of the most sustainable companies, we started with Morningstar's low carbon transition leader indexes. These indexes provide exposure to companies from each sector that are taking the most action toward transitioning to a low carbon economy. We sorted the constituents of the Morningstar indexes using IBD technical and fundamental stock ratings. We caught up with Maggie Stafford, Associate Director of Product Management Indexes at Morningstar, a leading global independent provider of ESG and corporate governance research, ratings, and analytics, to discuss what sustainability means today and factors investors can use to judge a company's long term viability.
I think now, in particular, professional investors really assess a company's sustainability through a concept called double materiality, which really means that they consider both the financial risks that directly affect a company's performance, but also the social and environmental impacts, sometimes called externalities, the things that matter to their employees, their communities, and other stakeholders. What's considered material would depend both on a company's industry, but also some unique characteristics to the company, like its governance structure, its financial position, and where it's located. So, kind of to break that down in an example, if you think about companies in the financial services sector, issues like employee well being and business ethics are going to be critical to their business success. And climate change matters, but more so for reputation and stakeholder trust and in the long run. Whereas if you think about an industrial company, environmental issues like energy use, pollution, and waste are critical because they more directly impact costs, right, through regulations and operational efficiency. So, practically speaking, this means that investors are going to look at both how a company makes its money or its revenues. They're going to look at its operations and resource use within those operations, and then all of the kind of programs, policies, and governance that underpins all of that and maintains checks and balances.
And in terms of the tools investors can use to evaluate a company's sustainability, you at Morningstar provide a low carbon transition leader index. Can you discuss the methodology of how that index is put together and constructed?
Definitely. So the Low Carbon Transition Leaders Index is really designed to provide diversified and broad market exposure. So taking the broad market of companies, but really focusing in on those that are leading in their sector on readiness and action toward climate transition. And so some of the primary data inputs that we use within that index methodology would first be carbon emissions intensity. So this is going to look at a company's emissions, including from its own operations, but also from its energy use and all the way through into its supply chain. And we kind of scale that for size. We also use Sustainalytics proprietary low carbon transition management score. So this is going to assess how well a company is positioned to transition in line with policy and market expectations. And the assessment's based on a set of indicators that are determined specific to a company's industry, but they could include, for example, things like the quality of the issuer or the company's targets, their policies, programs, strategy, governance, and financial position. And what's unique about this score is that it enables us to compare companies not only within their industry, but also across industries. And then the last kind of primary input from a data perspective is that companies' revenues. So we have a set of 64 economic activities that result in a product or service that is more environmentally sustainable. This could be, for example, development of green buildings or activities that are conducted in a significantly less harmful way or that generate more positive impact. Think energy generation from wind or from solar power. So those are the three kind of primary sustainability data inputs. And then the index methodology itself is what we call sort of best in class. So we're combining those measures and then ranking companies within their sectors. So comparing them to their sector peers and taking the top half of the market by market capitalization. And then we're doing some kind of upweighting or favoring companies that have a greater exposure to green revenues.
IBD used these indexes from Morningstar to target the top half of the best scoring companies from each sector by market cap. The list focuses on companies that report carbon emissions and are reducing their carbon intensity, as well as those whose business activities contribute positively to the environment. The indexes are calibrated on a biannual basis. How does the Low Carbon Transition Leaders Index different from other climate measures available to investors today?
So, in this day and age, there are a number of different types of climate indexes out there, and there's definitely been an evolution within this space. I think historically, the starting point was excluding, for example, fossil fuel companies. And then, as more companies started to report on their emissions and that data became more reliable for investors, really focusing on the companies that have lower emissions, or increasingly, those that have set net zero targets or have a net zero ambition. But what's actually unique about this index is that we pair kind of that backward looking emissions intensity data with a more forward looking signal in the low carbon transition management assessment that I mentioned. So that this assessment includes indicators that look more at implementation and not just ambition or targets. So, for example, Equinix Inc., which is a real estate company operating 260 data centers globally, a significant portion of this company's emissions comes from their electricity that they use to keep their servers running and keep them cool, especially when power isn't fully renewable. So, thinking about, as AI makes data centers use more power, this type of emissions, scope two, it's called, is going to rise. But this company in particular has strong GHG or emissions reduction programs. It also has made commitments to report on its progress against key milestones. And kind of underpinning all of that, it also has board and management level oversight of this through its GHG risk management program. And they have accountability through linking their incentives to these climate targets. So that's just kind of a few ways in which this index is differentiated from some of the other climate indexes that are out there.
And what are some of the common characteristics of companies represented in the index? Are there any particular themes or sectors that stand out?
So oil and gas, when you look at from kind of a macro perspective, accounts for about 15% of global energy emissions, or about 5 billion tons annually per the IEA. And so, what the Low Carbon Transition Leaders Index does is it takes a more pragmatic approach. And instead of excluding those high emitting sectors, companies in oil and gas industries, like, for example, the EU Paris aligned benchmarks approach does, it actually includes them, but it really prioritizes those that have credible transition plans, which means they're aligning their capital investment or capital expenditure with more low carbon tech, so wind, solar, and hydro, to lower their transition risk and actually really accelerate real world decarbonization. Morningstar conducts an annual study called Voice of the Asset Owner, where we both quantitatively and qualitatively survey a range of asset owners globally, of various sizes, including some of the largest public pensions. And what we hear from that survey is that institutional investors increasingly sort of favor this pragmatic approach and prefer, active engagement as a way to cut real world emissions as opposed to just focusing narrowly on the decarbonization of their portfolio or paper decarbonization. And this really echoes the work that you see coming out of other coalitions of institutional investors, for example, like the IIGCC, who are helping to kind of organize around these climate topics.
And then how would you characterize the current moment when it comes to sustainable investing?
So it's certainly been an interesting time for sustainable investing. And as someone who spent the vast majority of my career kind of tracking this space, I'd say from around, 2015, 2016 through to the early 2020s, it was a period of a lot of hype, a lot of excitement, and a lot of ambition. And I think maybe the flip side of that was also a bit of oversimplification and an overly simplified narrative that sustainability would always equate to good performance. In more recent years, there's obviously been a backlash. I think that's been, quite pronounced in the US, but has been in other markets as well. I think in Europe, the regulatory landscape has, fatigued a lot of investors and is currently undergoing a bit of an evolution in response to the geopolitical environment and changes there over the course of this year. So, I mean, there certainly remain barriers to pursuing a sustainable investment strategy, but it's interesting because the annual study I mentioned earlier showed that there was a jump in sort of the perceived impact on returns as being one of the biggest barriers. But interestingly, we don't see really solid evidence out there that shows that sustainable investing strategies consistently perform either better or worse than conventional strategies. And so, in terms of where we go from here, I'll echo Morningstar CEO who spoke at our annual institutional investor conference last month. And in his view, the backlash that really dominated the headlines last year has kind of given way to something that is a bit more durable. And that really takes back to accountability. I think investors aren't walking away from sustainability, but they're definitely demanding more rigor and more evidence and more alignment between what companies say and what they actually do on the ground. And I think that shift from ambition to accountability is sort of marking a new chapter for sustainable investment that's going to be more focused on outcomes.
Maggie, thank you so much for your insights today. We really appreciate it.
Thank you for having me.
For more information or to see the full list of IBD's most sustainable companies, go to investors.com/sustainability.